Every option has a price. But that price isn't just a random number. Every option premium is built from two completely different components: intrinsic value and time value. If you don't understand the difference between these two, you don't truly understand how options are priced. Today, we're focusing on the first component, intrinsic value. The word intrinsic simply means something that already exists by its own nature. Not something that might happen later, not potential, not probability. When we talk about intrinsic value in options, we're talking about value that exists today, right now, at this exact moment. Intrinsic value answers one simple question. If this option were exercised right now, how much real economic value would it have? Not tomorrow, not next week, right now. If exercising the contract immediately creates value, that value is called intrinsic value. If exercising the contract provides no economic benefit, its intrinsic value is simply zero. Let's look at a real option contract instead of a theoretical example. Apple is currently trading at approximately $324. This 320 call costs $14.75. Now let's look at another call with exactly the same expiration, but this time a strike price of $290. The premium immediately jumps to $38.55. Same company, same expiration. So why is this option so much more expensive? The answer is intrinsic value. Of the $38.55 premium, approximately $33.94 is intrinsic value. That's real value, value that already exists. Because this contract gives the holder the right to buy Apple shares for $290 while the market is trading near $324. The remaining $4.61 is time value. Together, they create the option premium. Now, compare it with the 320 strike. This option contains only about $4 of intrinsic value. Most of its premium is time value. This illustrates something important. The option premium doesn't tell you how much real value you're buying. You need to separate intrinsic value from time value. Intrinsic value has several important characteristics. First, it represents real economic value, not theoretical value, not expected value, value that already exists. Second, it depends on the relationship between the stock price and the strike price. As the stock moves, intrinsic value may increase, decrease, or remain unchanged. But one thing can never happen. Intrinsic value can never become negative. If exercising the option no longer provides any economic benefit, its intrinsic value simply becomes zero. Never below zero. Professional options traders don't simply ask, "How much does this option cost?" They ask, "How much of this premium is real value and how much is simply time?" Because those two components behave very differently. Understanding that distinction changes how you evaluate every option you trade. So remember this: intrinsic value is the real value already contained inside an option. It exists today. It can never be negative. And together with time value, forms every option premium.